Welcome, everyone. We'll give this just a moment as folks are dialing into this webinar. Well, hello, everyone, and thank you so much for joining us. This is the Climate Action 100 Plus webinar on accounting for climate. For the benefit of time, I'll start right away. Let's jump in and go to the next slide, please. I am Cynthia McHale, Senior Director on Series Investor Team, and I'll be the moderator of this session. This webinar is being hosted by Climate Action 100 Plus, the world's largest investor-led engagement initiative on climate change, along with Carbon Tracker Initiative and the Climate Accounting Project, a team of independent experts. Let's go to the next slide. So before we dive in, I'd like to recap that in the past couple of years, we have been bringing to the public's attention the need for companies to incorporate the financial effects of climate change in their financial statements. The transparency around this information should help investors and other stakeholders to press companies to take climate action and to help us avoid the worst effects of climate change. In 2020, investors representing over 140 trillion in assets under management published a letter emphasizing the need for companies and their auditors to consider the effects of material climate-related risks in financial statements. In June of 2021, Ceres published the report Lifting the Veil, which analyzed how the US oil and gas industry should address climate change in order to comply with already established US financial disclosure standards and to meet investor expectations for transparency. And then in September of 2021, Carbon Tracker published their report called Flying Blind: The Glaring Absence of Climate-Related Risks in Financial Reporting, which looked at the extent to which the financial effects of climate-related risks were reflected in 107 large emitters' financial statements. It also looked at whether auditors considered the effects of such issues during their audits. And this year, at the end of March, Climate Action 100 Plus released the new assessments of focus companies using the Net Zero Company Benchmark Indicator. This time around, the assessments included the indicator on climate accounting and audit. So with that, we'll move to the next slide. I'll go quickly through our agenda for the day. First, we'll be hearing about the methodology used for the new climate accounting and audit indicator in the Net Zero Company Benchmark. Secondly, we'll look at how the UK, EU, and US regulatory regimes support this type of disclosure. And finally, we'll hear from investors about why disclosure on this matter is important and how it is informing their voting practices. We'll then have time for a Q&A session. And I do also want to thank those of you that have sent in questions in advance. We got many questions, but we also welcome the live audience to send your questions via the Q&A tool. And we'll try to go through a good number of these, time permitting. To note, this webinar is open to the public, and a recording and slides will be made available afterwards in Ceres event page and Carbon Tracker's YouTube channel. So let's please go to the next slide where we will first look at the climate and audit indicator. We'll go to the next slide, please. As I said, the 2022 Net Zero Company Benchmark company assessments are now available on climateaction100.org. I invite you to go to that website to view those company assessments and to find out more about that framework and its methodology. With that, I'm going to now pass this over to Barbara Davidson. She is the head of accounting, audit, and disclosure at the Carbon Tracker Initiative. Barbara, the floor is yours.
Thank you, Cynthia, and thanks for having us. Thanks everyone for listening today. Good afternoon, good evening to everyone. Before I speak about the accounting related assessment work that we did, I wanted to briefly talk about why accounting matters when we consider climate related issues. And I also wanted to remind the listeners that the assessment that we did is not about sustainability reporting. So when we talk about this assessment, we're talking about the audited financial statements, the related notes to those financial statements, and the audit reports. We sometimes refer to this as the back end of the annual report or the SEC document. That's the information that is already required to be presented, accounted for, and disclosed today. So why does accounting matter? Well, many of the numbers in the financial statements are based on estimates and assumptions about the future, such as projected costs, forecast commodity prices, or estimated demand or production. So for example, estimated future cash in and cash outflows that management use when assessing asset impairments can be significantly affected by climate-related issues such as emissions reduction policies, emissions regulations, and these can lead to increasing costs of carbon or CO2 prices. There could be declines in demand, and these could lead to declining commodity prices or phasing out of products such as internal combustion engines, which lead to, say, electric vehicles or other disruptive technology, such as the use of renewable energy for power instead of fossil fuels. So these are some examples of how the inputs to the financial statements can be impacted by climate-related matters. I have a list of other examples on the slide, which I won't go through, but just to note that this list is not exhaustive. But remember that these issues can impact profitability and the size of assets and liabilities, which can in fact affect investment decisions that are made by both management as well as investors, which can also affect how management is compensated. So if we move to the next slide, Cynthia already mentioned that Carbon Tracker published the Flying Blind report last year, and this is related work that we did in this area. And I bring this up again because there are some similarities with the work we did for Flying Blind and the alignment assessment work that we did for the CA 100 plus benchmark. A couple of parallels can be drawn here. There are similar companies that we looked at. 92 of the 107 companies that we looked at for Flying Blind are CA 100 plus focus companies. We looked at fiscal year 2020 for Flying Blind. We started with carbon intensive sectors. So we started our assessment for Flying Blind as well as this assessment with an underlying assumption that climate related risks were already material to these companies and so would be material to their financial statements. And as you may have heard me, if you've heard me talk about Flying Blind, you'll know that the results of the work that we did for Flying Blind were disappointing, that there was little consideration of climate for companies and for auditors when we looked at these reports. And investors need this information to help them understand the extent to which climate is or is not being considered in the financial statements that they're assessing today. And so they can better understand a company's resilience to the energy transition and perhaps make their own adjustments as they deem necessary. And so if they lack this information, we not only risk material misstatements to the financial statements, but we also risk the potential for large loss of investor capital. And of course, we also risk not being able to achieve the targets, the goals that we'd like to achieve under the Paris Agreement. So if we move to the next slide, moving on to the Climate Accounting and Audit Alignment Assessment, or the CAAA, sometimes I like to call it. As a result of the work that we did for Flying Blind and ongoing investor concerns, as Cynthia mentioned, the CA 100 Plus had decided to develop a new indicator or alignment assessment for climate accounting and audit. So this is the first of its kind. This was developed, Carbon Tracker participated in its development, the Climate Accounting and Audit Project, along with the various partners that we have here and other partners. We developed the methodology based on a similar assessment that we did for Flying Blind, as well as accounting and auditing requirements today. As Cynthia said, the results were published last month. As for this assessment, we assessed 164 of the 166 CA 100 plus focus companies. That's because a couple of companies had some mergers, so we had 2 less companies to look at. We looked at their 2020 financial statements, and we hope to update those results for 2021 financial statements later this year. You can see the link if you'd like to also look at the full methodology that we use to make these assessments. So before I talk about the results, if you go to the next slide, I put together this pyramid to help illustrate the different parts of the scoring system that we use for the alignment assessment and how it lays the groundwork and how the score kind of moves up the pyramid. So the base or the foundation of the work that we did can be seen by the metrics that are scored using a binary yes or no system. And I'll talk about this in a few slides. But the metrics scores then lead up into what we call sub-indicators, for which there are 3 items that we look at. These sub-indicator scores can actually be yes, no, or partial, and they're determined, like I said, by the metric scores. And then the sub-indicator scores lead up to the overall score that the company will receive for this alignment assessment. And the company can either have a yes, they're aligned, no, they did not meet the alignment assessment, or they partially met it. So when I talk, and in later slides, you'll also see I put the pyramid within the slide so you can see which part of the assessment I'm talking about in these slides. So if we go to the next slide, as I mentioned, the overall score is based on the scores for the 3 main items, the sub-indicators that we look at, the middle of the pyramid across all companies and all auditors. And those are the financial statements, the audit reports, and then we also look at alignment with net zero by 2050 or sooner, and no more than 1.5 degree warming pathway. So these are, again, the same areas that we assessed when we did our work for flying blind. Similar to flying blind work, the first 2 areas, the financial statements and the audit reports, relate to information that companies and auditors are already required to provide today under existing auditing accounting standards. So we're looking for information that we expect to be provided because the information is material to these companies and because it's required to be considered today. Now, the third item, the alignment with net zero 2050 and no more than 1.5 degree warming, is not required yet by accounting standards. However, investors have asked that companies include assumptions and estimates that are aligned with achieving these goals when they prepare their financial statements. Or if they don't do that, investors have asked for a sensitivity of the relevant assets or liabilities to such information. And they've asked companies to provide this sensitivity. They've also asked auditors to assess if companies' inputs or estimates and assumptions are aligned with achieving these goals, or to do their own sensitivity analysis if companies have not done this. So those are the sub-indicators that we looked at. Now, if we go to the next slide, this is how we assessed those sub-indicators. So now we're getting into the detail of the work that we did for this assessment. So the first sub-indicator that we looked at are the financial statements, and there are 3 underlying metrics that we use to assess the financial statements of companies. First, we looked at whether the financial statements demonstrate consideration of climate-related issues. So we looked at for indications or for disclosures of whether management considered the financial impacts of the energy transition on the information that they're already using to prepare their financial statements today. So we're not asking for new information in terms of assumptions and estimates, but we're asking management to consider how issues such as new policies and regulations, emission reduction regulations, or perhaps disruptive technologies, or even achieving their own targets could impact the assumptions and estimates that they're using to prepare their financial statements today. Again, for items such as estimated asset lives, estimated commodity prices, estimated carbon prices, estimated other estimates that they use to determine cash flows, or other items such as perhaps decommissioning obligations or estimated credit losses, for example. Next, we looked for disclosure of the relevant quantitative climate-related assumptions and estimates that management uses to prepare the financial statements. So what we looked for items such as the estimated commodity prices used, the actual dollar amounts of those prices that were used, the actual CO2 prices or costs, the dollar amounts of those costs, estimated remaining asset lives, remaining lives in years, estimates of production, other types of quantitative information that management used to prepare the financial statements. We look for disclosure of this information. When we did this, when we assessed this metric, we weren't looking, these items did not have to consider climate for this metric to be met, but this information had to be disclosed because this is important information for investors and they use this information when assessing companies. The third metric that we looked at when we assessed financial statements is around consistency of what I call climate-related reporting, or the company's climate narrative. So we looked at whether companies are appearing to tell a consistent climate story. In order to do that, we looked at the front half, if you will, of annual reports, or 20Fs or 10Ks, such as the MD&A, the risk disclosures, management commentary. We looked at sustainability reports, other reports published by the company versus the audited financial statements. So what did we look for? We looked to see if the information and the stories that are being told looked aligned and connected. It looked, was the information that was used outside the financial statements, did it look like, at least directionally, it is consistent with the information that's used in the financial statements? For example, if a company appears to be continuing to use carbon-intensive assets for the next 30 years, how does that align with the company having emission reduction targets for 2025 or 2030? Did companies use the same investment and planning assumptions that they discussed in their sustainability reporting in their financial statements? These are the types of items we looked for to see if companies met this metric. To assess audit reports, we go to the next slide. So the second sub-indicator, the audit report, is assessed by looking at two metrics. We looked for, the first piece of this is whether auditors provided evidence that they considered the effects of climate-related issues or material climate-related issues when they audited financial statements. Most of the time we did this by looking at the key or critical audit matters that auditors include in their audit reports, and I think that Sam will talk about that a little bit later. But effectively, these key or critical audit matters relate to items for which there are significant judgments or estimation uncertainty. One example of this that we saw often in audit reports are impairments of long-lived assets. Impairments use long-term estimates for projecting future cash flows. The nature of these estimates are subject to judgment, subject to uncertainty. And also, as I mentioned before, impairments and the cash flows that are used to calculate impairments could be materially affected by items related to the energy transition. Again, such as commodity prices or asset lives or future changes in demand for products or production. And so we look to see if auditors indicated that they assess the financial impacts of the energy transition when testing items such as these audit matters. The second part of the audit report assessment is we looked at auditor consistency checks. So auditors are required to check the consistency of a company's financial statements with the company's other information, and that's defined by the auditing standards, but effectively it can be the other information that's included in the same document as the audit report. If there's an inconsistency between this information and the financial statements, this could mean there's a material misstatement of the financial statements, material misstatement, of the other information, or both. So the consistency check is an important piece of the auditor's work. And finally, if we go to the next slide, the last piece of the sub-indicators is the net zero by 2050 or sooner, and no more than 1.5 degree warming. Again, this is not required by the accounting standards, but as I noted before, investors have asked companies to use these assumptions and estimates, or at least provide a sensitivity of the relevant items to using such inputs. And so when we looked at financial statements, we looked to see if the inputs that companies use or the estimates and assumptions that companies use to prepare the financial statements were aligned with this pathway. We also looked to see if auditors assessed these inputs when they were doing their test of these companies. And we looked to see if auditors provided their own sensitivity analysis to these inputs if companies did not align with these. In order to assess these inputs, we looked to see if they are aligned with using assumptions and estimates that would be required under the IEA's net zero by 2050 scenario. So there's one other thing I would like to highlight. If we go to the next slide, about the assessment that we did before I discuss the results of this assessment. As I noted before, there are a lot of parallels that we could draw between the work we did for Flying Blind and the work we did for this assessment. And one of these is that we did assess the same areas or the same metrics for this assessment that we did for Flying Blind. We did look at the same seven metrics Again, 2 of those were not required today, but the other 5 are. As you can see in this slide, for flying blind, we used a 4-level rating system, although none of the companies or the auditors that we assessed for flying blind actually were rated as good practice. So effectively, we used a 3-level scoring system for our flying blind metric assessments. But by contrast, the benchmark uses, as I mentioned earlier, a binary scoring system for the metrics. And so we used the binary yes/no scoring system when we assessed the metrics for this climate accounting and auditing or audit indicator. So this means that companies or auditors could have avoided a red score in flying blind if they showed some evidence or some levels of consideration or disclosure of climate-related issues, even if it didn't seem like they considered these issues across the items that we thought all items they needed to consider in their financial statements. But by contrast, to avoid a no score for the climate accounting and audit alignment assessment, companies and auditors had to provide evidence that they comprehensively considered the effects of climate-related matters, of material climate-related matters on items that could be materially impacted by these issues. So we looked for the items that we thought would be the most affected by climate-related issues, and we expected companies and auditors to address all those items before we gave them a yes, meeting the metric. Of course, we also assessed companies at a holistic level, and we looked at different issues for different sectors and sometimes different regions. But overall, the different scoring system resulted in a greater percentage of red scores than flying blind for a similar population. And as a result of this binary scoring system, you'll note that any progress that a company or an auditor makes is not readily apparent. But we're thinking about ways that we might be able to informally help show differences between the no scores or variations in the no scores going forward. So finally, we get to the scores, the actual scores that we gave for our assessment. Going back to the top of the pyramid, the overall scores, whether or not companies and auditors met the actual assessment. Only 6 companies received better than a no assessment when we did this in March. So only 6 companies received better than a no, and they only partially met the assessment criteria. No companies fully met it. So that means that of the 164 companies that we assessed, 96% did not meet the assessment criteria. Only 4% partially met the assessment criteria. As I said, no companies received a yes score. So remember, these are mostly for the fiscal year 2020 financial statements. And so we did partly expect this results because of the work that we did for flying blind. A couple other items of note here. The 6 companies that scored the best had the UK and also the EU in common. This could be because the regulators here, such as the UK FRC, have started looking at these issues in the past couple of years, looking at whether companies have considered these issues in their financials and whether auditors are considering these issues. And I think that Sue will talk a little bit more about that in her presentation. Additionally, there are the investor engagement here has been going on also for several years. UK investors such as Saracen and Partners have been engaging with these companies over an extended period of time. And that may be another reason why we're seeing better disclosure of information in their financial statements. Remember, we're not assessing the quality of their energy targets or the quality of their net zero plans. We're just assessing the extent to which they disclose what they've done in their financial statements. We did find significant differences between regions again, as we did in flying blind, especially between the US and the EU and the UK, even though there isn't significant difference between the requirements between those regions. If we move to the next slide, we'll drill down now to the sub-indicator level. So we'll look at the scores for the financials, for the audit report, and for the third sub-indicator. You can see here, for the financial statements, only 2% of companies provided comprehensive evidence in their note disclosures about their consideration of the financial impacts of climate-related matters, or disclose the relevant climate-related quantitative, information that we looked for. So this means that without this information, investors don't know if management has actually considered these issues, and it's hard for investors to understand the extent to which their capital is at risk, the extent to which the financial statements already considered these issues today. When we looked at audit reports, the auditors did a little bit better. 3% of audit reports provided evidence of consideration of these issues. And you can see there's only one auditor, E&Y for Shell, that actually met both metric requirements for the audit report, for both consideration of climate, evidence of consideration of climate, and consistency checks. None of the audit reports for US companies discuss consideration of climate-related issues as part of their audits. So this means that investors, especially in the US, do not have the comfort that they need to understand if there was an independent assessment done on the effects of climate-related issues in financial statements. And no company or auditor actually performed the work that we looked for assessing whether inputs were aligned with net zero by 2050. No company used inputs aligned with that, and the auditors did not assess to this scenario. So there were companies that used some assumptions and estimates that were aligned with other types of scenarios, such as less than 2 degrees warming, such as the IEA's SDS, but none used the inputs that we looked for that would achieve this pathway. And finally, on the last slide for the assessments, we go down again to the metrics to the base of the pyramid. And this details out the metric scores for the 6 companies that received that partially achieved the alignment assessment. So you can see here, 2 companies met the assessment for comprehensive consideration of climate issues in their financials. There were other companies on this slide and elsewhere that did provide some consideration, but not enough for them to achieve a yes score here. So for example, Eni, who's not here, they received a no, because although they did provide some evidence of consideration of climate, it was still unclear to us if they considered the impacts of climate issues on other, what we saw, material items such as decommissioning liabilities or remaining asset lives. You can see here only one company provided what we assess to be a comprehensive disclosure of quantitative climate-related inputs. Again, there were a few other companies provided varying levels of disclosure, but not enough to achieve a yes. Another example would be BP, which was close, but BP did not provide the quantitative carbon dioxide price that it indicated it used in its impairment test, or the gross cost for decommissioning liabilities that it needed to estimate these liabilities, and so it did not receive a yes. You can see that no company scored a yes for consistency across their reporting. And so this means there's no through line from sustainability reporting to the financial statements. And so this is also greater potential for greenwashing if we don't have this consistency. The auditors again did slightly better than companies. 4 received a yes for consideration of climate. 2 received yeses for their consistency checks by indicating actually that the company's assumptions and estimates were not yet aligned with the company's own net zero targets. And as I noted before, 1 got a yes on both parts of the auditor report assessment. And again, as I noted, no companies or auditors received a yes for the net zero by 2050 sub-indicator. So that concludes my discussions of the results of the assessment. If we go to the next slide, this talks about what some of the engagement implications are for the results of our assessment. So again, as you see, most companies and auditors still are not appearing to consider climate-related impacts. So what can we do, or what can investors do about this? Well, investors can make their expectations clear to companies and auditors. They can engage with investee companies to better understand what the financial impact is that climate-related risks could be on company financial statements, on the audit work, on corporate governance, and whether the board or the audit committee is overseeing these issues. They can engage with the company to understand the financial implications of company climate targets. We have seen investors integrating this more and more into their engagement and their voting policies. We've seen voting on several occasions against the auditor appointment, as well as the chair or members of the audit committee. For example, also this year, we note there have been resolutions filed for both Exxon and Chevron to provide audited assessments of the quantitative impacts of using inputs aligned with the IEA's net zero by 2050 scenario. So we're seeing more engagement and more action by investors here. On my last slide, what's next? Well, as I mentioned earlier, we are looking at the fiscal year 2021 company accounts and audit reports. We're continuing to speak with market regulators about their work in this area and the need for better oversight and enforcement. We're continuing to do webinars like this and also help investors engage and educate investors in these areas. We'd like to speak more with the audit community and talk about how auditors can provide better transparency. And we plan on publishing a version 2.0 of Flying Blind later this year. So thank you again, and I'll pass back to Cynthia.
Wonderful. Thank you so much, Barbara. That was extremely helpful, and I'm sure it will be useful for stakeholders to navigate the net zero benchmark accounting and audit score or indicator. So moving on with our agenda, we'll now look at how the regulatory regimes support this type of disclosure. First, I'm delighted to welcome Sue Harding from Harding Analysis, who is part of the Climate Accounting Project. She'll provide an overview focused on the UK and EU markets. So Sue, welcome, and over to you, please.
Okay, thanks very much, Cynthia, and thanks for participating, everyone. So I think given that the benchmark results were the most positive for UK companies, I'm going to start there. The Financial Reporting Council, the FRC, was relatively early on the scene and continues to develop its approach on climate. And given its role across corporate reporting reviews, audit inspections, corporate governance, as well as investor stewardship, it's set up an internal ESG and climate group across the entity. And in November of 2020, it published a climate thematic, which concluded that basically all parties need to do more in delivering on existing requirements. All parties meaning companies, auditors, regulators, and indeed investors. Following this, in its 2022 priorities for monitoring annual reports and accounts, they identified climate-related risks and COVID-19 risks as both areas of risk and uncertainty that needed to be specifically addressed. And the general message is that companies should ensure that the impacts on their businesses are appropriately reflected in both the financial statements and the wider annual report. And this is particularly where investors may reasonably expect where a significant effect on the expected life or fair value of an asset or liability. Where they go on to say that one of their top problem areas with accounts is indeed impairment, which has already been highlighted as a key area for climate consideration. Their statements strongly resonate with the IASB's own educational materials on climate, published late in 2020. As for the EU, ESMA, the European Securities Market Authority, is the relevant authority for this. And it too has taken a very significant step last year by including in its enforcement priorities for 2021 financials, 3 C's, so COVID again, climate again, and credit losses. And these were announced in advance so that companies and auditors had time to ensure appropriate attention was paid to them in these most recent annual accounts. On climate, ESMA set out their expectations under 4 broad headings. The first is consistency between IFRS financial statements and non-financial information. And the emphasis here is that all issuers consider climate-related matters holistically across their communications, which is one of the topics that Barbara has touched on. The second point was that climate risks in IFRS standards should be followed, should be applied. The standards, essentially, they say follow the IASB educational material to consider the effects of climate-related matters when these are material to an entity. The third area was significant judgments and estimation uncertainty and requirements for related disclosure. Here they give lots of technical references to standards, including the requirements to also clearly explain why apparently significant climate-related risks have not had a material impact on the financial statements where this ends up being the case. And additional requirements on disclosures of assumptions, for example, those made in estimating future cash flows and impairment testing. Lastly, they tackled defining materiality, noting that the requirements are to take into account not only the quantitative factors, but qualitative aspects, and whether information on an item could reasonably be expected to influence a user's decision-making, regardless of its magnitude. For example, they cite considering the nature of a topic where it's highly scrutinized by the primary users of the financial statements, i.e. the investors. I think you can sort of reflect on all of those and see how they're articulated in the methodology that's been applied. So what are the next steps? I think we'll probably hear more from the FRC on their findings, probably sometime over the summer. In terms of ESMA, their priorities result from consideration by the constituent group of national regulators. Actual enforcement, though, is still the responsibility of those national regulators. And while the strength of focus may vary across these, I think it can be expected, and that focus expected to be to develop over time with experience. All of the significant regulators relative to the CA 100 plus focus companies, for example, regulators in Germany, France, Netherlands, have also made individual statements committing to a focus this year on climate reporting in the audited financial statements under existing requirements. So in summary, I think we can expect an escalating focus across European regulators this year. And thank you, and back to you, Cynthia.
Thank you so much, Sue, for your insights and remarks. Next, we're going to explore this topic from the US market perspective. And those remarks will be delivered by Samantha Ross, founder of Assurance Mark. So we will start. I think this is actually a recording, so I'll ask that we start that recording, please.
The U.S. and international accounting and auditing standards in the areas that Barbara and Sue described are largely the same in principle. That's because we're talking about some of the most basic accounting principles. For example, depreciation is a function of the value of an asset essentially divided by the period of time that a company plans to use the asset. Both U.S. and international accounting standards use many estimates that are based on future cash flows, which are inherently affected by risks. The risks of a changing climate and the disruption of the energy transition are no different. Because climate change and the energy transition can have such a profound effect on companies' estimates, investors expect them to be disclosed and explained in order that investors can understand the quality of a company's earnings in the face of these challenges. This is especially important for companies whose business models are dependent on emissions, whether from their operations, from their raw materials or suppliers, or the use of their products. For example, changes in consumer preferences may well have an impact on future cash flows from products and services that depend on emissions. In addition, when a company has committed to reduce emissions, that commitment may affect the use of high-emitting property, plant, and equipment. Investors demand and are entitled to transparency about these effects. Both the International Accounting Standards Board and the United States' Financial Accounting Standards Board have acknowledged and provided educational materials about the impacts that climate change and the energy transition may have on a company's financial position and results. In its recent proposal on climate disclosure, the Securities and Exchange Commission also took the opportunity to remind registrants that current accounting standards require them to consider how climate-related matters may intersect with and affect the financial statements, including their impact on estimates and assumptions. These are important guides for companies and auditors. When it comes to auditing, both U.S. and international standards require auditors to describe the critical or key matters that can come up in an audit. In the U.S., that means any matter arising from the audit that was communicated or required to be communicated to the audit committee and that relates to accounts or disclosures that are material to the financial statements and involved especially challenging, subjective, or complex auditor judgment. Disclosure of these matters has revolutionized what you might recall as the boilerplate standard form audit report. And so if you haven't looked at an audit report lately, you can find them in companies' annual reports right before the financial statements. The better audit reports provide a wealth of insight to investors looking to understand the most challenging estimates and other issues in the financial statements and how the auditor addressed those challenges. These reports demonstrate the value of the audit to investors. One excellent example related to issues that we're discussing today it provided insight as to how an auditor factored a company's net zero commitment into its assessment of the company's estimates of how long it would use certain assets for purposes of calculating an appropriate rate of depreciation. The auditor's work led to the company's decision to provide a sensitivity analysis in the notes to its financial statements, showing how depreciation would be affected by various scenarios for using those assets for shorter or longer periods. Other audit reports have provided extensive discussion about the pervasive nature of the impacts that climate change and the energy transition have on the company's financial results and position. These are almost like tutorials to guide investors through the various sources of impacts and financial uncertainty. They're immensely useful insights, and more than that, they foster confidence in the company's financial reports as the best estimates available at a point in time in light of the uncertainties. Each year, we're seeing more and more disclosure like this, but it's by no means consistent. Companies and auditors that are silent on the role that climate and the energy transition play in their financial reporting leave investors to guess, and that jeopardizes investor confidence in the company's statements and the quality of its financial results and position. The SEC is also concerned about investor understanding and confidence in the face of these risks. Given the nature of climate-related events and transition activities, the SEC has called for even more targeted tabular financial metrics showing the financial impact of climate change and transition activities on each line item of the income statement and balance sheet, as well as expenditures related to climate change and transition activities, whether capitalized or expensed. What you've heard today is clearly the direction of travel. I want to thank Ceres for all the work it has done to help investors and companies prepare and protect the resiliency of our public capital markets, which are needed now more than ever to support both savings and capital formation through the disruptive challenges of climate change and the energy transition. Thank you very much for inviting me to this webinar.
Wonderful, super interesting and important. So now we're going to switch over. That we've looked at the market standards. I'd like to pass this discussion on now to our investors so they can tell us how they're using disclosure of financial effects of climate change in financial reports in their activities. Let's start here with James Andrus. He is the Interim Managing Investment Director, Board Governance and Sustainability at CalPERS. James, over to you, please.
CalPERS seeks a true and fair view of the company's position and prospects in annual reports and accounts to better assess the company's performance, business model, and strategy, including climate change risk. We also care whether people are being harmed both economically and by exposure to health risks and fatalities in order to meet the financial goals of those strategies. This reflects our holistic approach to sustainable value creation, which includes our understanding that long-term value creation requires the effective management of financial, human, and physical capital. There's an immediate need for improved disclosure. In the US, we ask for a robust and transparent disclosure regime that includes climate disclosures in the annual and other periodic filings as a part of the formal corporate reports required under Regulation SX and Regulation SK. Where the information is disclosed matters. Voluntary public disclosures do not match the force of regulatory disclosures. For example, mine safety disclosures were always publicly available, but only when such disclosures became a part of mandatory public disclosures did mines become safer with fewer lives lost. Disclosures in financials are the most significant. They are reviewed by company decision makers and are audited. As such, the company and board focuses on the issues more, and the information more likely becomes a part of company strategy. We've aligned ourselves with significant industry leaders in the area, focusing on getting climate-related information into the financials. For example, Samantha Ross penned the paper, The Role of Accounting and Auditing in Addressing Climate Change. This is significant to have industry leaders and those with knowledge of the process to engage and be able to inform others and evangelize on the process so that we can fully enforce existing accounting and related disclosure requirements and the transition to a low carbon economy, and update disclosure through a staff accounting bulletin and other guidance and rulemaking to spread identified practices about material climate related information across industries and markets. We realize that this is no easy task, in part because the existing standard setters have not focused significantly on climate related issues. And when I'm talking about the standard setters, I'm talking about FASB in the United States and the IASB as the global standard setter. In order to get this information into the financials, we need for those institutions to research the issues and then place it on the technical agenda, provide proposals, and then finalize rules. Interestingly enough, we're finally where, the momentum is such that we're getting there. I think it's important to point out that through leaders like Saracen promoting getting net zero accounting into the financials, they've moved the needle. The most significantly with the Shell 20F. Note 4 of the Shell 20F actually considers climate in a very substantial way, and in doing so provides us substantially more information about Shell's financials. We need other companies to basically behave similarly. This information is substantially important. Without it, we could see material misstatements, but more significantly, we're not getting the information we need. It's important that we've been trying to get the information for a long time. In the US, we received environmental guidance in 2010, which was largely not followed. Interestingly enough, in 2017 at FASB, Mark Siegel penned a paper to further consider climate. Nick Anderson, more recently at ISB, took it a step further, assessing exactly how climate can be considered directly into the financials. And it's significant that we're talking about asset impairment, that's including goodwill, changes in the useful life of assets, changes in the fair valuation of assets, effects on impairment calculations because of increased costs or reduced demand, changes in provisions for onerous contracts, changes in provisions and contingent liabilities arising from fines and penalties, and changes in expected credit losses for loans and other financial assets. It is significant that we focus on the financials because we get the best information. This information is in fact audited and becomes more important to the entire infrastructure. As such, I'm very proud of Ceres and Climate Action 100+ in that they are evangelizing on these issues, making more people aware of what they happen to be so that we can move forward. Thank you very much.
Wonderful. And let's see, for our last panelist, I'd like to introduce Malcolm Ryers. He is the head of stewardship at Columbia Threadneedle. I believe his statement is also recorded. So we'll hear now from Mac.
Good morning, good afternoon, and good evening to everybody on the webinar. I'm Mac Ryerse, Head of Responsible Investment Stewardship at Columbia Threadneedle Investments. We are a global long-term asset manager with approximately 750 billion US in assets under management. My apologies, I can't join you in person, but I'm grateful that I can make a statement to you about the topic of today's webinar. First, we'd like to thank Ceres PRI Carbon Tracker for hosting the event, which advances the CA 100+ net zero benchmark, and particularly with the important addition of the accounting and auditing indicators. Second, we wish to acknowledge the hard work of all the organizations to help develop the framework. And it's not immediately apparent until you download the public data sheet from the CA 100+ website to see all the contributors. Most notably, though, we want to acknowledge the work of Carbon Tracker, the Climate Accounting Project, for their assessments. We do support the use of the benchmark by investors to assess, compare, and track performance of the highest emitting firms. And we're of the view that the addition of the accounting and auditing indicators presents a significant advance in the scope and depth of the benchmark and opens up additional avenues of focus for all investors to pursue with companies. And so we want to just briefly address, in our view, why are the accounting and auditing indicators so important to investors? And we think there are several areas I'm sure you will hear through today's webinar, but we'll focus here on one of them. So it's easy for investors, from our view, to be overly focused on emissions targets, interim milestones along a particular glide path. Absolutely critical and important, no doubt. But it takes truly engaging with companies to understand the totality of the massive expense they'll be required to achieve those targets. And in my experience, when you engage with companies and discuss with them their investment hurdle rates, the financing of major projects in a rising rate environment, and they're truly long-term capital allocation plans and not just the traditional typical 3-year CapEx plans, only then do all parties begin to think about the massive financial impacts on the enterprise and society, and how, if improperly managed, that could be significantly detrimental to the enterprise, among other things. So expanding the conversation beyond CapEx to bring this to the financial statements and the assumptions that underpin them become critical, and where the indicators are truly additive for our discussions. And that also, of course, leads to the discussions on which assets may ultimately become stranded assets through the course of our engagements. So fundamentally driven investors, and that's the vast majority of us, in our view, really need to be waking up, and quickly, to how these very factors are playing out in companies' financial statements, and not only questioning whether they're being properly managed. That's the fundamental question for us as investors, but we cannot even begin to undertake these analyses if there is no data, or data are improper, or no reliable assumptions that underpin them. And this is where the accounting and auditing indicators can become of tremendous value to help advance these discussions and provide investors with new tools to assess the companies and to gauge progress. So just shifting to concluding remarks and a stewardship perspective for a moment, we'd like to just make a couple of observations about how investors perhaps can use indicators in practice. And the first is thinking about the role of the audit committee. And audit committees are the elected representatives of investors like us, who bring specialized expertise and critical thinking skills to bear on the quality of the accounting disclosures and the audits that provide assurance for the companies where they serve. And this is the group that must think and act like shareholders, whether large or small, and how, in this massively critical risk area, disclosures must be accurate, standardized, and considered and reflective of climate risk. The data also need to be reviewed by them and fully under their purview. If not properly managed, our view is audit committee members can become targets for voting action, and we expect that will continue to ramp in months and years going forward. The second then is around how we'll integrate these into our own work, in addition to escalating and voting action. And we will be using the indicators to screen and prioritize the firms that we engage with. We'll also be using the indicator as a driver of our engagement discussions. And with many firms, I expect we'll be setting engagement objectives to seek to drive change by raising awareness of the indicators and driving for firms to adopt. So thank you for your consideration today of our remarks. We look forward to more discussion and evolution on the use of these new tools in investor and company interactions. Thank you.
Wonderful. Okay, thank you everyone for sticking with us. We've covered a lot of ground here. We're going now to a few questions, time permitting, and thank you everyone who has taken the time to submit your questions. We received a few that relate to disclosures available in those front-end reports, so you may want to check those for some of that insight as well. But for this webinar, we'll be focusing on questions that relate to information that's provided in the audited financial statements, as again, we refer to those as the back end of the annual reports. So one question I'm going to start out with here is, how long do you believe it will take for effective implementation? And just before I turn this question over, I think it's a good one for Sue. This is actually already happening, right? So as the panelists have said, companies should already be disclosing material information and investors are already incorporating this request for better transparency and disclosures in the company's financial statements, and they are voting accordingly, and they're holding audit committees and the director that leads that committee responsible. So Sue, would you like to elaborate on that a bit more and maybe some of the details around the standards, please?
Sure. I think, yeah, as we said, sort of the requirements exist now, both under international and US standards. Some companies are doing better than others, which is, you know, it's nice to see some pulling ahead and kind of starting to show the way in terms of how some of these requirements can be met and how one goes about articulating some of these somewhat uncertain issues, but make a start in terms of spelling out assumptions and spelling out how climate is being considered. I think the important thing is really going to be the trend and direction, and I think the regulators now focusing to a greater degree will also help sort of focus attention on that. But it really is important, the trend and the direction. I think we're now getting the 2021 year-end accounts. It's a little bit too early to tell on those, and the assessments will be done later in the year. It's a little bit premature. Nonetheless, I'll probably go as far as saying that we're seeing some progress, but you know, not nearly enough progress on this. So I think actually this year and the type of engagement that can take place, and so we're really focused on those issues that matter most. So the impairment assessments, life assessments, that kind of stuff, that's going to be critical to both making sure that companies and auditors both develop their practices on this and really think about how to communicate what they've done in the reporting for this coming year end. And I would hope this coming year end we will see kind of a step change.
Great, thank you so much, Sue. I'm going to try to squeak in one more question before we wrap up, and this may be for you, Sam. What type of assurance should auditors give on ESG reporting?
Yeah, sure. Thank you so much for that, Cynthia, and for including me in this excellent webinar. So as Barbara mentioned earlier, the auditors do a consistency check with some of the other disclosures that the company makes, but not included in that consistency check is statements that the company makes in its voluntary climate or sustainability reports that are outside the financial statements. The auditor is not even required to read those statements. Moreover, the audit procedures don't really relate to the financial statement auditors procedures don't really relate to the data that's often provided in those documents, which we know are challenging for investors to read because there does seem to be a lot of inconsistency between companies' voluntary climate reports and the financial statements. I think it's very important actually that the auditors start getting involved in those documents to improve the quality and the reliability of what's disclosed in the climate reports. The SEC has actually proposed that auditors, that companies have to submit to audit their scope 1 and 2 greenhouse gas emissions. Of course, they would also move those disclosures into the 10K, which I think would be a very positive step. And they have said that if companies choose to get assurance over their scope 3 disclosures, that need to do it at the same level of quality that the SEC will require for scopes 1 and 2. I think those are extremely important steps. The SEC has kind of done this in a step basis, where at the beginning, the greenhouse gas emissions disclosures will be audited according to limited assurance. I personally think that is it's fine for a very short period. It's of limited utility, though, because it doesn't really provide investors that investor grade assurance that the auditor has really taken a look and tested the data and looked at what how the company's processes pull together their greenhouse gas emissions disclosure. And that's why the SEC has proposed that pretty soon down the road, companies will have to get reasonable assurance. I think that'll be critical. I think it'll give the auditors much more information about the business models risks that are posed by climate change and the energy transition, and will further help financial disclosure improve.
Thank you so much, Sam. I wish we had more time, but we're at the hour, top of the hour. So I wanted to just wrap up by going through some important messages. First of all, the CA 100 plus net zero accounting and audit indicator is considered provisional. So if you have feedback, you can participate in the public feedback survey that you can access by going to the CA 100 plus website and clicking on the link. The public survey will be on until the end of April. Also, if you have any questions, you can use the contact information on the final slides. If your question is directed to Carbon Tracker about their work and the methodology of the new accounting and audit indicator, you can contact ca100@carbontracker.org. Otherwise, feel free to contact me or Tracy Cameron at Ceres. And last, I would warmly like to thank very much all of our speakers and all of the people that are behind the scenes putting this webinar together for this really important discussion, and to the audience for joining us and asking very good and important questions. Have a wonderful rest of your day, and thank you again, everyone.